Hello everyone, today we are going to have a look at a great company called Rio Tinto plc. Before we dive into the analysis, a risk disclaimer. We are not registered financial advisors. The opinions are just our own views and investment decisions should not be made based on these opinions. Please consult a registered financial advisor before investing. Rio Tinto is a big Australian miner involved in the mining of iron ore, copper, and aluminium. Their ADR are listed in NYSE. Most of their iron ore mines are in Australia in the Pilbara region, but they also have some mines in Canada. The thing that piques our interest is on the Simandou mine located in Guinea. It has one of the largest deposits of high-grade iron ore with estimated reserves of 2 billion tons. This mine is in the early development stage in partnership with Chinese companies. Iron ore contributes to majority of their free cash flow with excellent EBITDA margins of 69%. Their main copper mine is the Oyu Tolgoi copper mine in Mongolia. It is one of the largest known copper and gold deposits in the world. It is still being developed, but 80% of the capex is already committed. Copper production is currently at 168 kt. Oyu Tolgoi operating assets of 14 billion represents 25% of the group total, and they are expected to ramp up production to 500 kt between 2028 to 2036. It is set to become the world's fourth largest copper mine by 2030. Currently copper production is free cash flow negative. But as production ramps up they are expected to generate 4-5 billion in gross revenue and 3-4 billion in free cash flow. They are world leaders in low-carbon aluminium with 4 bauxite mines and 4 refineries with associated infrastructure. They have capacity to increase production depending on market conditions. Currently aluminium margins are depressed and contribute only a small proportion of the free cash flow. Rio Tinto also produces titanium dioxide and is involved in early-stage lithium projects. Currently they are cash flow negative. The 2 important growth drivers are the reasons why we like Rio Tinto so much. The Simandou project with high-grade iron ore will contribute to significant increases in free cash flow. Also China's need to diversify from iron ore from Australia is also an important reason why holding Rio Tinto stock is a good idea. China is the most important importer of iron ore. The Oyu Tolgoi copper project will also significantly improve cash flow from 2028 onwards. Rio Tinto plans to spend about 3 billion per year until 2026 on growth capex. Most of this will be on the Simandou mine. Coming to iron ore demand, there has been concerns about Chinese growth and the demand for iron ore. However, Chinese imports of iron ore actually increased in 2023. It remains to be seen how much this will affect demand in 2024. Rio Tinto contends that steel demand is reshaping from property sectors to manufacturing and infrastructure investment. Global commodity demand is expected to grow by 4% a year until 2035. Slack in demand from China will be replaced by growth in India and other emerging economies in Asia and Africa. This is world population growth chart, and we can see that even the rate of growth has been slowing. The population is still growing and is expected to reach 8.8 billion in 2035 from the current 8 billion. More population equates to more demand for commodities. Copper demand is expected to increase by 45% in 2035, aluminium by 57% and lithium by a staggering 945%. Iron ore demand is expected to increase by 18%. Mining projects involve a lot of time and capital, and new mines are hard to come by. Rio Tinto is in a sweet spot in our opinion. Now coming to the balance sheet, their free cash flow was 7.6 billion and their net debt was 4.2 billion even after accounting for growth capex in Oyu Tolgoi. This debt is low for a company with a market cap of 106 billion, and this financial strength is another reason why we like Rio Tinto stock. This provides a margin of safety in a downturn in world economy. In summary, we are looking at a great company with solid balance sheet and great margins. They also provide attractive dividend, and their growth projects will start increasing cash flow from 2028 onwards. So we rate this as a buy and will be a good addition to your portfolio if you are bullish on commodities. There is always risks to any analysis. Commodities are very sensitive to the economy, and near-term weakness in China is a major risk, and recession in China might cause commodities to weaken further and can pressure the share price down. We think that this is already reflected in the price of commodities, and although there may be short-term weakness, the long-term fundamentals are still strong. If you are bullish on commodities, you can consider Rio Tinto stock as a half position and add to it if share price falls further. In the meantime, we can continue to collect the dividends. We hope that you like this video, and if you do so, please like and subscribe. Thank you.